Now, can the U.S. economy continue to grow even as oil prices climb? Let's get some perspective from my next guest, Jerry Webman. He is the chief economist and investment officer at OppenheimerFunds. Jerry has been a professor of politics and public affairs at the Woodrow Wilson School of Public Affairs at Princeton University. We're not going to hold that against you, Jerry.
Please don't.
Okay, never would do that. So, all right.
I got over it.
You got over it?
I'm cured of that now.
Thank you. Now, let's look at the U.S. economy in the context of rising prices. We got the report today, consumer prices, the PPI numbers, the producer prices yesterday. Is the Federal Reserve accurate when it says that these price increases are transitory?
I think they are, because you're also seeing in the numbers we've seen this week an okay, but not exactly aggressive expansion of the U.S. economy as we continue to come out of this recession. So you got to have a lot of demand. It's the old cliche, a lot of money, too much money chasing too few goods. I also went to Chicago. You don't have that. You don't have a lot of pressure from the demand side of the economy. In fact, demand remains okay, but not at all exciting. So I think, the answer is probably is transitory.
But that doesn't necessarily sound like a great thing, because if you're telling me that the economic growth in the United States is so weak that it isn't producing inflation, the only inflation that's going to filter into the economy is inflation we don't have any control over, and that has to do with things like rising commodity prices, because the rest of the world is going about its business.
It's very tough to be dependent, to be a commodity importer, particularly food and fuel. Be glad you're not India, where 45% of the household market basket is food, 4 times what it is here. So that's right. If you're not producing energy, this is a fairly difficult economy. On the other hand, Pimm, as you know, another cliche, the cure for high prices is high prices. So supposedly we're already starting to see some demand destruction. That is, you and I are going to figure out how to do things to conserve energy, to, do meetings by electronic means or whatever, rather than traveling. No wasted trips. That, of course, is going to put downward pressure on fuel prices as well. So it tends to equilibrate, but it's not a very exciting picture.
Now, these are the last sets of inflation data, inflation numbers that the Federal Reserve is going to be able to analyze before their meeting on the 26th and the 27th of April. So we look ahead to the meeting at the end of the month for the Fed experts. What do you think that they're going to do? Nothing?
Tell me what we've learned that should change their mind. They're showing kind of growth. They're showing growth that's sort of fast enough to sustain an expansion, not fast enough to absorb the big slack in employment, the number of people who are unemployed. It's not, and inflation, core inflation, which is for good policy reasons, if not humanitarian reasons, good core inflation is pretty benign. The month over month was down from last month, 0.1%. It's not, they haven't learned anything new, so I'm sure they've learned a lot of things. They're smart people, but there's no new information that would cause them to change the policy that they put in place last fall.
All right, so having said that, when you look at the return that you would get by loaning your money to the government for 10 years, 3.4% right now, is that going to go up?
I think over the next year or so, it will go up. And of course, that's the consensus, and it's been the consensus for a while. And even though there was a significant increase, don't forget, last summer we were well below 3%. So that's the consensus. I don't know when it's going to happen, but it's low enough now and enough upward pressure that lending money to the U.S. government is probably shouldn't, in my opinion, be the core of anybody's investment portfolio right now, investment strategy right now.
What does this mean for the future value of the U.S. dollar? Because if you take a look at what's happened to the dollar versus the euro, the head of the European Central Bank, they raised interest rates. That doesn't sound like a very good prescription for the value of the greenback.
Well, of course the currency is going to trade around a lot. But let's look at what currencies do. Over long periods of time, currencies reflect the trading value, exchange value of currencies. It reflect the relative strength of the underlying economy. The U.S. is going to continue to have a great economy, but it's going to shrink as a proportion of the overall world economy. that means the dollar is probably, over most of our planning periods, going to lose some of its purchasing power relative to foreign currencies. Not necessarily the euro, but probably some of the currencies that we find a little harder to pronounce.
So does this mean that investors ought to be looking to put more of their money outside the United States?
I think investors surely should be looking to put money where the growth is, especially given how much that growth is going to be outside the United States. Thinking about foreign currency denominated bonds, that's tough. It's something that's very difficult for most people to get their arms around. So I'd say for most investors, it's something to begin thinking about studying before you really begin to make some decisions. But people are probably going to want to move that direction over the next years.
We're speaking about inflation and what the second quarter might hold for investors. My guest is Jerry Webman. He is the chief economist and investment officer at OppenheimerFunds. Jerry, the notion that inflation, gasoline, food prices, they're going up. Retail sales also going up. How is it possible that the U.S. consumer is finding money to spend, and yet everyone howls because gasoline is reaching $3.78 a gallon?
Well, we're cutting more paychecks than we were. We're now finally getting to a trend of 250,000 new jobs a month. There's still an awful lot of people unemployed, but sometimes you've got to
look. About 412,000 for the unemployment claims, right? New unemployment claims.
It was a bad number this past.
They say maybe it was like an aberration, right?
We'll see. But what's worse about the unemployment, by the way, is not just this one number, is that for many weeks now it hasn't come down very much. So I don't want to paint a great picture of employment. All I want to say about employment is that it's better. And you cut more paychecks, and people will put off purchases, people will make purchases that they've put off. That's the nature of printing paychecks. So we print those paychecks. It gets us a little more retail sales. You notice in the retail sales number this week, though, big ticket items, notably cars, the second most expensive. I guess since nobody buys houses anymore, it's now the most expensive thing to buy.
But car sales
were down.
That's right.
So it may be that people are buying less expensive things. They may be replacing a shirt they wore out, but maybe they're not replacing the car quite so quickly. So you got to kind of sort through the data, and don't mistake bad for not getting better, and getting better for not yet being great. So we're kind of in between. It's a transitional situation.
Tell me about the manufacturing sector of the economy, because that has been a standout. That has been, in a sense, what's leading the economy. Yeah. And the numbers still bear that out.
Yeah, it's surprising. Maybe it comes back to the discussion you and I had a few minutes ago about a weaker dollar on a trade-weighted basis, that there are places around the world where the dollar has gotten a little cheaper. And so if we're not exporting more, and the export numbers say we're not really exporting as much as we thought we were, maybe we're just doing a little more, maybe we're consuming more of our own manufactured goods. Also, don't forget, we're neck and neck with China as the world's largest manufacturer. We tend to forget about that. We do make a lot of stuff here, not what we used to. So it's probably a currency effect. It's probably makeup from the fact that we shut down so much manufacturing and we're bringing it back online, heavily weighted toward technology, things that are knowledge-based, that kind of stuff.
All right, so the manufacturing sector, that keeps moving ahead. Do you think that in the future, and I mean maybe the third quarter, the fourth quarter, does the economy stall because the Federal Reserve pulls back that quantitative easing program and stops spending money on U.S. Treasuries? Because that's a lot of money, $600 billion in the economy.
Yeah, but remember, here's the jargon among economists. It's stock, not flow, that matters. One way to think about it, if you freeze the orange crop in Florida, the price of orange juice goes up. You don't have to keep freezing orange groves around the world to keep the price of oranges elevated, at least for some period of time. So just buying all those treasuries, taking them off the market, holds up the value of treasuries, and also by holding up the value of the price of treasuries, the yield down, makes riskier assets like stocks a little more attractive.
Well, does this mean that when that stimulus dries up, that stock prices, in your mind, fall?
No, I'm trying to say the opposite in my own jargonized economist way. You know, it's Friday afternoon. But in fact, it doesn't drop off. It's not falling off a cliff. The impact of buying those $600 billion in treasuries lingers for some period of time. And what the Fed has told us they're going to do is, well, if then things continue to go well, we'll start using other tightening mechanisms we have, reverse repo and interest on excess reserves and all these arcane kind of things.
In other words, the money, for example, that banks have to keep at the Federal Reserve, and they get paid interest for that.
And make it better to keep them at the Federal Reserve than lend it out. If they need to do that, they'll do that, which right now I don't think is the case. So they'll be watching it by the fall. We'll get more tightening if the economy is accelerating and inflation looks like it's on track. Core inflation, which is what you watch from a policy point of view, even again if you don't watch it from a human being point of view. If core inflation looks like it's accelerating, well, then we'll see some more tightening in the fall. But I think it's very much wait and see.
What about wait and see when it comes to the housing industry?
Well, I think it's just wait for the housing industry. I think it's wait for those echo boomers, the kids who are in their mid-late 20s, as they begin forming households, as people do in their late, early 30s. We just didn't have enough babies.
When they get a job, maybe.
When they get a job matters a lot, but the demographics just matter. We didn't have any babies in 1975, with all due respect to what 35-year-olds we have out there. There's just not enough people the right age to be buying houses, in addition to everything else that's happened in the housing market. So if you're waiting for your house to become your retirement plan, I'd say think again. A few years from now, the housing market probably begins to improve, but it ain't what it used to be.
All right, so you need a plan B if you want to retire and you don't want to look at the house as the piggy bank. Right. What about the U.S. government and its piggy bank, the debt ceiling? That's going to be a topic for debate coming up. What do you think happens as we get closer and closer to the debt ceiling?
Why do you think I stopped teaching political sciences so I didn't have to think about this stuff? I think the rhetoric will get hotter, and the backroom dealing, I hope, will get more intense. I mean, so far what both sides have said is that here are our demands. It reminds me of SDS in 1968. Here are our non-negotiable demands. Nothing's going to change. Well, of course it's going to change. What's good is we've gotten this issue on the table. Entitlements are being discussed. The tax structure is being discussed. We do things incrementally in this country, but we'll do some things we're going to fix this. We're just, not going to fix it very well.
From your lips to congressional ears.
Well, yeah, maybe so.
I want to thank you very much.
Thank you.
Jerry Webman joining us from OppenheimerFunds, economist there.